Well, there we have it, 5.3%, and that from from June's 5% figure. Any surprises on your end? Much of a muchness that's come through.
No, it's definitely no surprises. What we've seen is what we expected to see. We saw that electricity prices over the month went up. We all knew that. We felt the pain personally. That went up 16% on a month-on-month basis. So that was quite a big driver. And then the other one was basically water and other services. Again, your sort of administered prices, that was up 8.7%. And as for the rest, there really wasn't much.
Yep, as you say, that differentiation coming through when you're looking at things on a month-on-month basis, 0.9% higher on month-on-month from the 0.4% we saw in June. Let's take a look at what you're anticipating in terms of rate cuts, because much of the market anticipating a rate cut coming through, some saying a bit premature, given the inflationary threat that persists. Where do you stand right now?
Well, you see, it really depends on whether we all know that inflation will tick up, and it's coming off a low base the same time last year. So that was the lowest point really in your base. So your cycle has turned now. You're calculating off that very low level. So over the next 6 months or so, you'll see inflation tick up. We've got inflation at 6% by year end. I think the Reserve Bank in its last forecast had it just slightly breaching that 6% level. And your key drivers there, in our opinion, is going to just be the base. It's going to be the biggest factor, and then a slow increase in food and fuel prices, which doesn't reflect what's happening in the global markets at the moment, but the earlier surges we experienced that, of course, drove up cost across the system. So that's really what's going to take it up until December to around 6%. Thereafter, it depends on your view of the global economy. Do you think that 6% is going to be a pretty permanent feature, or you think it's going to be a temporary feature? And that's the question the Reserve Bank will ask themselves. They've already given us an indication that they think it will be temporary. We would agree with them. And in the last 3 months or so, we've had a lot of evidence to suggest it will be temporary. And it's mainly coming from the world economy. And we're seeing, Europe is struggling with some serious and complex debt problems. We're seeing the US also facing fiscal issues at the same time. Evidence of their economy slowing quite rapidly. The consumer losing confidence. Unemployment still remaining a problem. Manufacturing production looking far more sickly than it used to. And also then, of course, China, which is the big unknown. They slowed certainly during the second quarter. Manufacturing has looked a lot weaker coming out of China. But then we had their PMI out, I think it was today or yesterday, which suggested a bit of a bounce again. So there's still a lot of uncertainty, but what is clear is that global growth has slowed. And that is our central view too. We think that the Reserve Bank won't overreact to a temporary spike in inflation. And so it is definitely leaning to the more dovish side. And they will anticipate that going forward, global growth will be very weak, therefore commodity prices will ease. And as you continue, the consumer, is probably also not going to give retailers pricing power, so why overreact?
Let's take a look at that, because focus has to be placed on, the health of the South African consumer, where right now there are few signs of any domestic demand pressure contributing to these inflation numbers that we are seeing, where we're seeing this ticking higher.
Exactly, and you don't have that kind of consumer that's going to take cost increases and just accept them. And in fact, you've got a consumer that is still very vulnerable and very, very uncertain about the future. And we can see that in the fact that there's no real demand for credit either. So people only spend what they earn. And if their earnings come under pressure, they spend a lot less. And that's already what's happened. We've already seen it in the second quarter numbers. I mean, for South Africa to get GDP above 1% in the second quarter is going to require quite a trick of the unknowns. If we just look at what we know about manufacturing production did, what manufacturing production did, what retail sales did, it's going to be a weak second quarter number. And that, I think, is where all these calls of possible cuts are coming through, along with the statements made by Governor Martinus suggesting, that they're very worried about the situation in Europe and the world economy and what its impact on our economy will be. So that's why people are thinking, well, maybe they will cut. I think it is a little bit early. We haven't changed our forecast, but the one thing that is clear for us is they're not going to hike anytime soon. And so we've pushed any possible interest rate hikes out to May next year.
Of course, you talk about impact on that broader economy. Let's hone it in and look at what it actually means for business here, because last week we had the trade activity index come through and showing, for instance, that while you've had input prices rising on the one hand, selling prices held steady, and therein lies a very big risk, because surely business can only absorb those cost pressures for so long.
They can only do that, and margins are under pressure, and they'll have to continue to look literally to make efficiency gains. And the rand, although it's weakened a bit, it's now over 7 rand to the US dollar, is still strong. So no matter how you look at it, businesses are being squeezed, and especially in the manufacturing sector, and we're seeing that coming through in less production. So they are taking strain. But at the end of the day, if you cannot sell goods at the higher price, you just have to take the pain.
So you have no choice.
You have no choice, and that's the bottom line. And where does it ultimately come back to? It comes back to readdressing your cost structure. So the implication of this is quite bleak, especially for employment.
Of course,
so if other costs are going up,
yeah,
and you can't sell for more to keep your margin, you have to retrench.
Absolutely. Let's take a look at PPI, because this is the kind of dynamic that will influence the kind of number we see coming out tomorrow. Expectations there?
Well, we're looking for 8.5%, so that's from 7.4%, so it is going to move higher. And the big shot there will again come from electricity prices, because we saw those increases, we knew they were coming. And as for the rest, there might be some moderation in commodity prices coming through. PPI picks it up quicker than CPI, which tends to lag by about 3 months. So we might see the global, softening that we've seen in commodity prices. They certainly haven't dropped through the floor, but they have at least eased a bit. And you might see that come through in PPI as a little bit of an offset to those electricity price increases.